Hello and welcome to BQ Prime. You're watching Talking Point, and my guest today is Rajesh Kothari, founder and managing director at AlfAccurate Advisors. Rajesh, thank you very much for joining us on BQ Prime today. Uh, let's begin with the current market and global cues that's coming in. A mixed signal coming in from the US on the Fed rate hike. For last 2 days, we saw consumer and the producer price index falling, but at the same time you had the retail sales which are down for October. What is your take on how the global markets are taking the cue, and how do you think that's going to impact emerging market flows?
Well, let me tell you, I'm not the global macro strategist, but the data points which are coming from US, one thing is very clear: the worst of inflation is behind you. Worst of supply chain shocks are behind you. The worst of the hikes of interest rates are behind you. Correct. The important is from here on, you will see probably plateauing out and then gradual reduction in the core inflation, and then eventually that will result into the lower interest rates. One thing which is basically, if you look at US CPI and if you break it up in various components, the rent is one thing which is keeping the inflation very high, and there is some technical error here because the rents are not reflecting the current rents, but they are actually reflecting the renewal thing, right? So if you look at the Ziglo rent index, so there is an index called, a company called Ziglo, and if you look at that rent index, that index is almost down, if I'm not wrong, about 75%. So the current rentals are actually down significantly compared to the past rentals. And because there is a lag effect of probably 1 or 2 quarters, eventually even that will get reflected into the CPI numbers. So I think, inflation by and large is going to be under the, what I would say, lower territory compared to what we have seen in last 12 months. And therefore, interest rates eventually, be it in month of May or be it in month of June or July, one don't know, but I think eventually even that will start reducing to some certain extent. So net, I think the good part is that the emerging markets, particularly countries like India, are on a very strong wicket, and that's why probably it will remain the focus. What I would say, focus portfolio, focus country to look for any global fund manager, from here on.
How do you see the current earnings season that just ended, half year? What has been your assessment of that?
Well, I think the earnings growth has been very, very strong. And, this quarter has been exceptionally strong, if you ask my view, because the Nifty has reported more than 20% earnings growth after, probably nobody was expecting this kind of a growth in Nifty. And if you look at the entire universe, 3,700 companies put together, the earnings growth has been very strong. I think more than 30%. So what is happening in this quarter is that the reduction in core commodity prices, the lower commodity prices in the world, and also, of course, the lesser freight index, both these are resulting into very strong expansion in gross margins. And that's basically supporting the very strong earnings growth across the universe. Particularly sectors like automobiles, sectors like cement, sectors like banking and finance, sectors like metals, and even oil and gas. These all are contributing to the bulk of the incremental earnings growth of Nifty. Even if you take out oil and gas, because there are a lot of inventory gains or losses, and even if you take out such commodity sectors, the Nifty earnings growth, even the universe earnings growth, has been reasonably strong, double digit, 18-20% plus. So earnings growth is very, very strong. And I think, we've been writing about in our AAA Insights that this is a structural bull market, because we have seen winter of earnings holiday for 12 years. From 2009 to 2020, 21 kind of thing, we have seen holiday winter season for India. GDP was growing at nominal terms 11-12%, but Nifty earnings growth was only 8%. FY22 was the first year where earnings growth was double digit. Of course, the base was in your favor due to COVID. And then FY23 was the second year where earnings growth is strong double digit. And then the first half of FY24 is on a very, very like-to-like basis, normalized earnings, if I say so, is a third year of earnings growth. So when you enter into the structural sustainable earnings growth of double digit, that's how the bull market gets created. Am I right? So if you look at 2003 to 2008, for 4 years, 5 years, Sensex reported 30% compounded earnings growth. And that's why Sensex became 5 times in 5 years. So for the structural bull market, you need one, good earnings growth. Second, you need continuity of good earnings growth. And of course, third, you need improvement in ROE. Now, all these three factors, earnings growth is double digit, number one. Number two, it is for the third year, very important. And number three, of course, it is coming with a low debt, low credit cost, less leverage, a clean balance sheet, and therefore ROE is also improving. These are the typical things what is required structural for structural bull market to sustain from here on.
Are you not worried about the consumption slowdown or a slow pickup that is happening, because that's leading to could lead to a trickle down effect on various sectors that are dependent on consumption?
You are absolutely right, Sajid. You are absolutely right. And in fact, this was a cause of worry because we have seen last 2 years consumption has not picked up. Earlier, they were impacted by the COVID because the income growth collapsed, particularly at the lower strata of the demographics. And then, due to one or other reasons, demand never revived. But from here on, in fact, if you ask my personal view, from here on, we are very bullish on consumption theme. Because first, this is a year where if you look at the government spend, the MSP prices for two important crops, wheat and rice both, wheat and paddy both, they have increased a sharp increase in both these. And these are the two most important crops for rural economy, right? So we will see from here on a better rural economy revival driven by better MSP prices supported by government, number one. Number two, this is election year. So you will see significant spend on the rural side of it. Number three, your base, of course, is in your favor. Number four, the inflation is coming down. So the purchasing power of rural economy is going to be better, which got impacted significantly, particularly the lower strata. If your inflation runs at 10, 12, 20%, because food items, inflation was very high, correct? Is definitely it gets impacted, the consumption gets impacted. So that will also drive the demand, correct? So all these factors will lead to better demand growth for the consumption sector from here on in our view. And we are from now on, because we have been actually underweight, the many parts of within consumption sector in our portfolios. But from here on, I think it makes very interesting space because the valuations are also compressed. From last 3 years, many of the companies have not done anything, and the demand growth is going to be better. Gross margins expansion we are already seeing. It means the earnings growth will also follow. So consumption from here on can be actually very interesting bet.
One of the themes that you follow is the mid cap and small cap theme. Give me a sense, where is the interest coming in that theme? How has that segment done in terms of earnings? Many of the themes that we have worked in the last couple of years all fell in that space, mid cap and small cap space. So how have your portfolio done, because you have a couple of portfolios under the PMS? So how are they faring?
Well, it is doing extremely well. Our budding beast is our mid and small cap PMS offering, and it has delivered 30% compounding returns last 2.5, 3 years, doing exceptionally well. And here, what we are doing is that instead of focusing on the micro caps, we are basically focusing on companies which are market leaders. So it is very, very differentiated, portfolio construction. So instead of buying a very, very small company, because please remember, from 250th company to 5,000th company, every company is called small cap. But actually, if you look at from the profit bucket perspective, there are about 800 companies in India which makes net profit in excess of 50 crores. Only 800 companies. And there are only 600 companies in India which makes net profit in excess of 100 crores. That's it. To us, that's our universe, and it's that universe which is actually growing and doing significantly well because they are benefiting from unbranded to branded. They are benefiting from demographic. They are benefiting from rising consumerism, better aspirations. They are benefiting from unorganized to organized, correct? They are benefiting from the credit crisis, the high debt companies which were underwater. They are, of course, closing down in last 3, 4, 5, 10 years. So these are the companies which are actually market leaders. Most of our portfolio companies, they're very low leverage. Many of them are debt free. They are actually net cash. And they are growing their earnings by 18, 20, 25%. Many of these companies in the manufacturing side, they are becoming now globally competitive. So China plus one and Europe plus one is also adding to their exports growth. Domestic economy definitely is resilient. That is further boosting their growth. So, across our portfolio company, that's basically the monitoring list from which we try to figure out the companies and consumption theme, auto ancillary theme, and capital goods theme. If you remember, we discussed, one half, from last 24 months, we have been discussing it, the capex theme. These three themes have been extremely rewarding for us in our, across our portfolio, and more importantly for our mid and small cap offering budding list.
Anything new that's coming up in a thematic fashion for you or in this space? Because we've seen a lot of funds, retail money flowing into small and mid cap. In the earlier few years back, if people were investing money into those sectors, entry used to be easy, but they used to get stuck. But now liquidity also has come into this sector. So how do you see the small and mid cap space in that light? And do you see that the volatility which was associated with this sector has now, ebbed a bit?
Well, I think too many questions in one question. So let me try to answer each part separately. So first, coming to the, as I said, I think we need to differentiate. We cannot paint any company from 250 to 5,000. Everything cannot be painted with same brush, correct? So you need to differentiate between that. So 250 to 400 company, 400 to 600 and 600 and beyond, or 800 and beyond. That's basically the right way to look into it. What has happened in the market, if you look at market particularly in last I would say 6 months or so, the tail end of this universe from 1000 to 5000 rank, that have seen the disproportionate share price increase. Am I right? That's the size where we are a little bit worried from now on, because the fundamentals probably are not that strong, correct? Our focus remains between that 100 to 600 kind of a bucket. That's basically so if you look at like elephant, correct? So elephant, the head and tail, if you remove the mass, is actually the huge, correct? That's basically thing which we are focusing on, because that's where you are going to see the companies which are going to compound by 20, 30, 40% and potentially probably multi-bigger over a period of time. So that's number one. Number two, if you look at the underlying return on capital employed of the small cap universe, earlier 10 years back it was 12%. Large cap ROC, return on capital employed, was 18%. So it's a huge gap of 600 bips. Welcome to FY23. The small cap ROC is expanded from 12 to almost 17%. So the difference between large cap and small cap in terms of the ROC has narrowed significantly, correct? And on top of it, the earnings growth has been definitely much stronger. Most of these names which I am talking about, from 100 to 500 names, many of these companies are now debt-free. So the underlying business models have become more resilient. Now, what it leads to, and that's what I'm trying to address your third point, the underlying volatility. Why the earlier volatility in many small cap companies were very high? Because they were significantly getting impacted by any macro factors disproportionately. For example, if the interest rate goes up, if the crude oil goes up, if the inflation goes up, you used to see collapse in small cap stocks. But since many of these companies are now debt free, the underlying volatility is also reducing. Silently, this is what is happening. It's probably less talked about in media. But if you look at the underlying volatility of small cap companies, is reducing compared to what it used to be 10 years back. I remember those days of 2003 to 2012, where index used to stop. Many stocks used to go down 30% in 2 days and 40% in 3 days, correct? But now, if you look at it, even if the market is correcting, whenever market corrects, and small cap index also corrects by 2-3%, you don't see 20-30% decline in many of these companies, And the why? Because the underlying business model has gone for a significant change. Many of these companies are debt free. Many of these companies' ROE has now become 20% plus. Correct? And these companies are now cash rich. So their ability to fund their next level of growth is very high. Maybe because of QIP, maybe because of IPO, maybe because of private equity, maybe because of data availability. And that brings resilience.
And cash on the books, basically.
Absolutely. So they are self-funding. Many of these companies, at least the portfolio which we invest into, most of these companies are funding their growth internally.
How do you look at the valuation for these companies? Do you think they're now stretching a bit?
Well, I think if you ask my view, valuations are always a subject of debate, be it a large cap or small cap. I think, irrespective of its market cap, what is most important is look at the underlying business model. Look at the sustainability of that growth for next 2, 3, 4 years. You can't probably forecast beyond that. Look at the resilience of the growth. And if that growth is resilient, be it a noodle company or be it a paint company or be it a luggage company, forget the market cap. If a noodle company can command 60p and 75p and 80p, and the paint company can command, say, 65p, a luggage company probably can also command 60p or maybe 40p, maybe 50p. I don't know. What I'm trying to give food for thought is that just because it is a small cap, that doesn't mean that it will command only 10, 20p. It's a small cap, yes, but it's the largest company in the luggage or market leader in the luggage, with a debt-free balance sheet, with a 20% ROE, and with a 30% earnings growth, significantly better and faster growth than the paint and noodles company. Why should trade at 40% discount or 50% discount to this FMCG universe? Correct? So I think, forget about market cap. Look at the profit size, look at the balance sheet, look at the growth, and look at the future growth prospect. If these four things are in your favor, the valuations will not remain cheap, because there are only a handful of such companies which are available in India. And you need to pay the fair value to get such business.
That's a good point to end today's discussion, Rajesh. Thank you very much for joining us on Talking Point. That was Rajesh Kothari, founder and managing director at AlfAccurate Advisors. Thank you for watching Talking Point.
Thank you, Sajid.